Hi, my name is Andrew Gradman. Today I'm going to give an introduction to new California Proposition 19. Specifically, I'm going to focus on those provisions which will cause additional property tax to be assessed whenever there's a transfer of real property between parents and children, starting February 16th of 2021. This presentation is intended for professionals who work in tax, real property, or estate planning, and I'm hoping it gives you a more in-depth analysis than the stuff you may have Googled. But before I begin, two caveats. First, I'm a tax lawyer. I'm not an estate planner. If you're thinking of transferring real property to a child, I'm happy to discuss the tax consequences, but I want to remind people, I always remind people that you ought to be thinking of tax consequences as secondary. That's why they're called tax consequences, and to treat the transaction itself, in this case, the estate planning, as primary. So unless you're an estate planner, your first phone call after hearing this presentation should be to your estate planner. Second caveat, if you came here looking for tricky loopholes that will let you have your tax cake and eat it too, consider yourself warned. I spend a lot more time in this presentation poking holes in other people's loopholes than I do proposing loopholes that do work. This is turning into a pattern in my life. If you enjoy this style of presentation, you might also enjoy the podcast on my LinkedIn profile page, Where Do Loopholes Come From? And if you don't, I suppose you may still want to know your prognosis, even if the prognosis I have to offer is not a good one. First, some history. From California's founding in 1850, the property tax was the state's primary source of revenue. Starting in 1910, this tax was then basically devoted to local government. Today, the state's government's largest source of revenue is the sales and use taxes and the personal income tax. The property tax goes mostly to supporting local public schools, including junior colleges, and it's further supplemented by nearly half the revenue from the California General Fund. Then in 1978, the equivalent of a California earthquake occurred. And that's a quote from a treatise on California property taxation by Sean Flavin. He continues, quote, "It took the form of Proposition 13, also known as the Jarvis-Gann Initiative. Several factors combined to generate an almost desperate spirit of revolt in California's property taxpayers. These included concerns over waste and inefficiency in government, the proliferation of government programs, overregulation, and the shrinkage of real income produced by inflation and progressive income tax rates. But the single most inflammatory factor, the one that fanned the flames, was the dramatic increase in the burden of the property tax, particularly on California homeowners. In the 16 years before 1978, assessed values in California tripled, tax rates increased by 51%, and property taxes themselves more than quadrupled," end quote. So, okay, prior to Prop 13, the tax on real property was basically an ad valorem tax, meaning the base for the tax was the property's current fair market value. What Prop 13 did, among other things, was it put a cap on the property tax base. Under Prop 13, the base still starts with the current fair market value, but now it shall not exceed the prior fair market value as of the last change in ownership or new construction, adjusted for inflation. In other words, Prop 13 replaced the old ad valorem tax, a tax based on current fair market value, with an acquisition value tax, a tax based on acquisition value plus inflation. And the trick here is that the inflation rate used is artificially designed to be lower than the rate at which California real property has generally been appreciating. So the longer you hold property, the more your property tax bill benefits from Prop 13. Now, in the last 4 decades, Prop 13 has had a lot of critics. Some argue it deprives schools of revenue, that it's regressive, that it unfairly burdens homeowners, and that it encourages something called lock-in. Lock-in is a tax term referring to limitations that a taxpayer has to undertake as a cost of accepting a tax subsidy. These are limitations which distort behaviors away from the otherwise efficient choice they would have made. You see this with the income tax, where property owners are subsidized by not having to pay tax on current appreciation until they sell. The longer you hold the property, the more sticker shock you feel when the tax bill comes due at sale. You are still better off than if you had to pay the taxes currently. But what's happened now is we've made it economically worth your while to change your behavior, either by avoiding a transaction entirely or paying a lawyer to change the nature of the transaction into something that won't trigger the tax, like a 1031 exchange, an installment sale, or the ultimate victory, doing nothing and dying in order to give your kids a step up in basis. So something similar happens with Prop 13. Prop 13 subsidizes uninterrupted ownership of property. But now again, the longer you hold the property, the more sticker shock you'll feel as soon as there is a change of ownership or new construction leading to reassessment. Again, even though you were better off with Prop 13. This distorts behaviors by discouraging new construction and by discouraging non-exempt transfers. It also distorts behaviors in favor of exempt transfers. So what is an exempt transfer? Well, Prop 13, these are transfers which aren't going to cause a reassessment, and Prop 19 has the effect of expanding and reducing the scope of some of these exempt transfers. On the one hand, for taxpayers over 55, the severely disabled, or victims of a wildfire or natural disaster, it expands the exclusion. It makes it easier for these people to transfer the current assessed value of their homes to a replacement home. It used to be for the 55 and older that you had to get a property of lesser or equal value where you'd get no relief. You had to downsize. Now you don't have to downsize. If you upsize, you start by carrying over the old assessment, and then to the extent the home is of a higher value than the old home, you add that in to the assessed amount. So it's a mixed exemption. It also used to be that you could make these transfers only within the same county or to counties that had special agreements with each other. Now you can go California-wide. So that's all really nice, but that's not what everyone's talking about right now. Everyone's focus is on the other part of Prop 19. That's the part which eviscerates, yes, eviscerates, the existing exclusion for parent-child transfers. So let's start with what the current law is on parent-child transfers. This exclusion was added 8 years after the passage of Prop 13. It was added in 1986. And for the next 8 weeks, it can be found at Revenue and Tax Code section 63.1. This provides that if real property is transferred from a parent to child or from a child to a parent, the otherwise assessable change in ownership will be disregarded in either of two cases. First, where the property was the principal residence of the transferor, and second, in all other cases, as to all other real property, but only up to the first $1 million of full cash value transferred, or $2 million for a married couple. Full cash value meant the fair market value as of the last change in ownership plus inflation. So it just basically refers to the tax base for the current year, the number you're trying to protect on your tax bill. So until now, a husband and wife could use this $2 million exclusion to transfer as much as $1 zillion in fair market value of property, as for certain values of zillion, as long as these properties were assessed at $2 million for property tax purposes. Another thing to note is the definition of child. Child included and still includes a natural child, a stepchild for the duration of the step marriage, any child-in-law until the marriage is terminated by divorce or until death plus remarriage. It also includes an adopted child, but only, I know what you're thinking, only if adopted under age 18. And in my opinion, that under 18 requirement is a critical backstop in the entire property tax regime for a reason whose proof is left as an exercise to the listener. The favorite question I get from a client is, can a sibling-sibling transfer be broken up into an excludable child-parent transfer followed by an excludable parent-child transfer? And the answer is formally, according to the rules as written, yes, but it actually only works until you're caught, at which point it does not work anymore, because the assessor applies something called the step transaction doctrine. So don't do it. Finally, note that the parent-child exclusion only refers to transfers of direct interests in real property and also beneficial interests in trusts. It does not apply to interests in corporations, LLCs, or other business entities. But that's not a bad thing, that's a good thing, because for those entity transfers, there's an even more favorable rule, which I won't be going into in this presentation, but that rule's not going away. So it means that if you're dealing with property that the parents initially purchased in an LLC, Prop 19 has, and I say initially purchased, not bought and then contributed later, I mean initially purchased in, Prop 19 has no impact. None of this presentation applies to them, and you're in a different regime, more favorable regime. Okay, so what I've said so far, it was just to encapsulate existing law. Effective February 16th, Prop 19 will change these rules as follows. First, for transfers of property that is not the transferor's principal residence, going forward, no exclusion whatsoever. They're getting rid of that 1 million or 2 million for married people. There's something for family farms, but I won't go into that. Second, as for the transferor's principal residence, there are two big changes. The exclusion will only apply if the recipient, let's say the child, will continue to use the home as their personal residence immediately after the transfer. So let's get into that. What does immediately mean? Nobody knows. But you can expect the legislature to provide a definition soon enough. In the meantime, I'll just note that under Prop 19, the child has to file a homeowner's exemption within 1 year of the transfer. And on that document, the child swears under penalty of perjury that they're living in the house. There's also no statement of how long the child has to live in the house before they can leave it and rent it out again. But again, if you're asking that question, the legislature is asking it too, and they get a second bite at the apple. They're going to pass statutes on this after February 16th or before. So if you're not planning on moving into the house in the common sense meaning of the phrase, you're taking a risk that I'm warning you about. Okay, the other big change in the exclusion is that whereas the old principal residence exclusion was unlimited in value, under Prop 19, the exclusion gets phased out as a function of how valuable your house is today, and also as a function of how much of that value isn't being taxed as part of your current assessed value. So the rule in the statute's a little clunky, but I've distilled it into an equation which I think is very easy to use. Basically, the new assessed value will be the greater of the assessed value before the transfer, your old number, or the current fair market value of the house minus $1 million. It's worth repeating because this is helpful. The new assessed value for that residence after the transfer will be the greater of the old assessed value before the transfer, or the fair market value minus $1 million. What this means is that the amount that's not going to be reassessed gets smaller and smaller for more expensive homes and for faster appreciating homes. I'll give examples of both. So let's start with homes of different value. Let's say you have two homes. Over the course of 10 years, their inflation adjusted value doubles. So they're appreciating at the same rate. Adjusted assessed value doubles, fair market value triples. So these numbers are moving at the same rate as to both homes. And then in both cases, of course, the homeowner then transfers the house to a child who moves in, and it takes advantage of the parent-child exclusion. Where these houses differ is that the first house was $1 million at the beginning of this process. So by doubling in value, its assessed value doubled to 2 million, and its true worth tripled to 3. So now what's going to happen to the property tax after the transfer, after the transfer of the child? My equation says that we start with a 2 million assessed value, and then we compare that to 3 million fair market minus 1 million, constant, and compare that with a tie. So 2 million is the new assessed value. Bottom line, the child will be taxed on 2 million assessed value at a 3 million fair market value, or he was only taxed on 2/3 of the property's fair market value. What if the house started at a higher value, $10 million instead of 1, and we use the same multiples? So its assessed value doubled to 20, its fair market value tripled to 30. Same equation, compare 2 million versus 30 minus 1. 30 minus 1 is bigger, so that's going to be the appraised value of the house, $29 million. So now they're being taxed on 97% of the appreciation in the property. So as the houses get more expensive, that $1 million less useful. We get the exact same result if we make this a story about equally valued houses that appreciate in accordance with the pattern I just described. So let's start with two $1 million houses, but this time the other house ends up appreciating, so its fair market value is 30. And I guess 20 might not end up being the number you use, but you would still have the result of $29 million assessed value. So when I say that the value of Prop 19 parent-child exclusion gets smaller and smaller for more expensive homes and for faster appreciating homes, that's what I mean. So what do we do now as planners? What can we do now before the law comes into effect? First, primum non nocere, first do no harm. The first planning point is to make sure you're talking to a client who actually cares about any of this. For younger clients, the taxes we're talking about may be too far in the future to even be worth taking the time to plan about. For other clients, their whole purpose of holding these properties for such a long time to the next generation was merely to get the step up in basis and death. And the whole plan was for the kids to get properties at that point, assuming that the next administration and the next Congress doesn't tamper with that step up. It's being talked about. Assuming it's not tampered with, then that family would have no reason to change their behaviors. On the other end of the spectrum, maybe you have a client who is indifferent to anything except property tax results at the next level of the next generation, sort of a tax Scrooge kind of figure. And then what mom and dad should do immediately is they should deed their residence to their kids and start paying rent to the kids. They should pass down all their $2 million worth of full cash value of other property to the kids. And they should celebrate as they live in penury and misery because their kids now are the ones making gifts to them. But at least they've achieved their goal. Okay, those are the two opposite ends of the spectrum. How about normal people? People who are in the middle of the spectrum. Those are the people who pose challenges for planners because they come to us and they say, okay, can you make it possible so that we don't have to do any of that stuff, transferring stuff to the kids because we don't want to, but have the assessor, think we did and give us credit for having done so. And I assure you that the greatest minds in the tax planning community are right now trying to think up solutions to that challenge. I'm also working on it. I'm at the end of the spectrum that says that, yeah, there are some things we can do, and I've learned these from other planners who've shared them, but not a lot. And let me explain the limits. Let me say why it's so hard. So the goal, the definition of the problem is simple. We're trying to accelerate a change in ownership between parent and child. But under Revenue Tax Code 60, you cannot trigger a change in ownership until there's been a transfer of the right to beneficial enjoyment, including the right to occupy and the right to rent. So right there, unfortunately, that's exactly the thing that clients want to make it possible that they should not have to do, is the thing the statute requires them to do. So for example, let's say you create a trust, but you cut corners and you give the parents the right to current income with the remainder to the kids. Well, as I just said, a change in ownership requires a change in the right to current beneficial ownership. And this is elaborated in 18 CCR 462.160. These are referred to as annotations, annotation 462.160. So that's not going to work. You get a similar problem when instead of income tax, it's the use of the residence as a residence. Now the problem is that if mom and dad don't pay rent, then there's been no beneficial change in ownership. Now, I've heard one attorney who feels that for property tax purposes, the rent paid by the parents does not have to be fair market value, and that the assessor would honor sort of a token rent. They didn't provide authority, and so I assume they meant that they have anecdotal evidence from their experience that they've never seen the appraiser take a contrary position. Two responses, well, three, but I'll keep that one to myself. Two responses. My first is, as lawyers, we don't use anecdotal evidence. We rely on legal authority. there's no common law in the assessor's office that says that the way they've done things for a very long time creates some kind of stare decisis. They can always change their mind. And second of all, now is a good time for them to change their mind. Until now, nothing was at stake in the question of the timing of a parent-child transfer because it was tax neutral. So they were not motivated to correct you, but now they are. So yeah, to the extent you try to solve your Prop 19 problem by transferring your house to your kids and then paying below market token rent, I expect that if the assessor gets wind of it, they will challenge the arrangement, and I expect that they will succeed. Another dilemma that people are wrestling with right now involves QPRTs. That's qualified personal residence trusts. These are split interest trusts where the parents retain the right to live in the property for a stated number of years. Then it goes to their kids, and at that point, again, the parents have to pay rent going forward. Everyone always pays fair market rent because there's clearly in the income estate tax provisions, everything has to be fair market or it'll be disregarded. The main reason for using these trusts is that they reduce the amount of estate tax and gift tax on the transfer of the house. Okay, but here's the problem we're facing today. Suppose your client is in year 18 of a 20-year term, and at the end of that 20th year, the property will be transferred to the interests of the children. Well, that 20th year is after Prop 19 comes into effect. This is an irrevocable trust, so very little, nothing you can do. What can be done? You can amend there are actually ways to amend irrevocable trusts. You can terminate these things. That most thoroughly you could do it by going to court and getting an order. But when the IRS gets wind of that, you violated terms in 25.2702-5C, which contains all the rules on how QPRTs are supposed to work. So the question is there a way to achieve the Prop 19, Revenue Tax Code 60 mandate of transferring a beneficial ownership sooner while honoring, you want to hear that again, 25.2702-5C 1 through 9 requirements? Again, the best minds of a generation are working on this problem. I know this because I've been invited to watch. I think it is insoluble. And I think that years down the line, there are going to be a lot of IRS audits of these efforts, and it's going to result in very unfortunate results. And that's why I'm personally not eager to get my hands involved in tinkering with a QPRT. Here's a similar dilemma involving, again, irrevocable trusts. In families where the first spouse has died, the decedent may have arranged to fund a marital QTIP trust or to fund an exemption trust with real property. And when they did this, they were relying on existing law, which said that their $1 million exclusion amount, or maybe you have a residence, would not be applied until such time as the second spouse, until the second spouse died and the property went to the kids. Again, I know of people who are wrestling with these issues. It's beyond my pay grade, to tell you the truth. I don't know. I don't think there's a solution, but that doesn't mean there isn't one. Okay, so now that I've talked about what we cannot do before February 15th, what can we do? Here's where the consensus of folks is. If you're willing to transfer the property to your children, and if you're willing to have them be legally entitled to the income from that property, in trust is fine, so it's held back. And that includes that for your residence, it would be the rental value of the continued use of your home. Then there are absolutely ways to set up trusts of this kind. There are even ways to do this which will allow the property to stay within the parent's taxable estate, which for most families is a good thing because that allows the kids, that's what allows the kids to get the step up in basis after the death of the parents. Mechanically, this is probably accomplished with an incompleted gift trust and by causing the parents to retain a special power of appointment. Authority for this, CCA 2012080026 and annotation 220.0447. You can even have a third bite the apple, which is that parents may be able to retain a large portion of the income from the property by arranging for the transaction to be a sale to a defective grantor trust in exchange for an installment note. So this is where the consensus of planners lies. This is service you can get from any educated planner. Although at this point we're beyond my scope of my practice. I'm not an estate planner. So if you have clients who are candidates for this kind of work, you go to an estate planning attorney. Two more caveats to talk about. One is the due on sale clause in mortgages. In the course of transferring any property that is subject to a mortgage, make sure to confirm that the transfer will not accelerate the loan. You either check the terms of the loan agreement, or you verify this under the protections of the Garn-St. Germain Act, or the best solution is to call the lender and get their permission to do what you're about to do. Maybe you will also have to contact the title insurance company. Maybe there should be an inexpensive endorsement that you may want to buy. The other caveat, how long do we have to make these transfers, given that this is all wrapping up on February 16th? Well, first, as a basic point, when you do the transfer and when you fill out the PCOR, you must tell the assessor that you wish for them to treat the date of the transfer as other than the date of recording. And this is important because there may be delays with the mail or delays with recording. You may send the deed in on time, but it gets recorded after February 15th. And so you want to put them on notice that the date of recording is not the date you transfer the property. You do this on the second page of the PCOR, top of the page, part 2A. Now, once you've done this, is that it? You walk away? No. I've heard some lawyers talk about it like you've just covered all your bases. But look, here's what the law says. The recorder starts with the rebuttable presumption. The date of recording is the date of the transfer. Now, rebuttable presumption. A lot of people get confused about what a rebuttable presumption is in the law. These are facile things. All it means is that in the condition in which you present no evidence whatsoever to contradict the presumption, then the assessor is entitled to win by default, and then the recording date is the date of transfer. But it says nothing about the alternative case in which you do present some evidence in your favor. I mean, at that point, you have to rebut, you have to convince someone that you've overcome the presumption, and that we don't know what is sufficient to overcome that presumption. It's sort of so we know that 0 is not good, but what scintilla of evidence is sufficient to help us here? Well, okay, what about filling in that PCOR? When the PCOR is filled in by the buyer, it's signed by them. At the bottom of it, it says that this statement is true and correct to the best of my knowledge. And they write that the transfer occurred on a particular date. That will clearly overcome the presumption in the sense that they don't win by default, but you still may lose, on the merits, the old-fashioned way. So how can the taxpayer win? Well, it's really kind of screwy. There is a list of examples in annotation 462.260 stating what will count as sufficient as a transfer, but this is useless. It starts out with examples of sales, which is not our situation. So the stuff about contracts and escrows, useless. We're dealing with mostly, I believe, with sales, with gifts to a trust, outright gifts. And then the insight we get is from example 3, which reads as follows. A transfers property to an irrevocable inter vivos trust. The date of the change of ownership is the date of transfer. So yes, this is where your tax dollars go to write this stuff. So bottom line is that in a gratuitous gift transfer with no sales contract, we don't have one paradigm of what we know the assessor will consider sufficient to rebut the presumption that the date of recording is the date of the transfer. I mean, we will only know after February 15th when the assessor starts litigating these, and they win some and they lose some, and the ones they lose are the ones that you should have done. But now we need to make our guide our actions accordingly. So I'll tell you, here's what a lot of professionals are hanging their hats on. First, get your deeds in early, because we would much rather not have to have this issue come up. And then as a backup, we expect it to be sufficient if you can somehow prove the date on which the executed deed was delivered to the transferee. And the authority for that is Revenue Tax Code 60, Civil Code 1054, Civil Code 1055. The delivery of a deed to a transferee completes the transfer, and that's what Revenue Tax Code is asking for substantively for the trigger of the tax, reassess, change in ownership. Now, as I mentioned, the PCOR is relevant to this. The PCOR, you sign that to the best of your knowledge, this is the date on which you received the property. But if we're planning for litigation under these uncertain circumstances, one can do better than that. What attorneys are doing is they're procuring a dated and notarized affidavit by the transferee stating that the deed was delivered to him. It's more specific than the PCOR, on a particular date. And I like to go, I just want to specify further that whenever I'm using a notarization as my way of verifying a date on a document, I like to make sure that you use a single page document or get that notarization material on the same page as the date and the signature to further prevent some accusation that you messed around with the documents, and makes it a more useful proof of the dating. Wow, okay, it's an important topic, so I had to go into a great deal of detail. Okay, finally, once we're done with February 16th and we're looking down the horizon at this new law going forward, what are things going to look like in this brave new world? I would say that on the whole, Prop 19 does make the law simpler. Of course, it increases taxes, and I'm very sorry about that. But I think we'll also revel in the fact that as planners, those of us with malpractice insurance that we worry about, there's less screwing up we can do. For example, in the old days, if the parents left property to the children 50-50, they take advantage of an exempt transfer. Well, what if the children then later agree that they didn't want to be 50-50 and they want one child to have the property? Well, that's a separate transfer, sibling to sibling, and the assessor would absolutely scrutinize and identify these all the time and reassess 50% of the property when it could have been a direct transfer to that one child. And so, it'd be very dangerous to have a trust that expresses the wishes of the parents that my children should have a 50-50. Better to just leave it to the trustee. But then, we're not really doing estate planning, are we? We're taking some control out from the parents. So it's putting faith in the trustee. Under Prop 19, we can finally go back to, good old fashioned, like, who do you want to have your house who do you want to have your property kind of dialogues with our clients? Because for property tax purposes, we're indifferent to where the dice roll. If the kids get the property and they don't want that, they'll just transfer it amongst themselves in their own fashion. And they've already been reassessed, so things couldn't get any worse. From that point, it's a tax-free transaction. Principal residence, things get harder, though, and this is kind of the opposite outcome, because now, as an estate planner, you should be asking your client, does any of your kids want to reside in your property? It's probably not a question estate planners are in the habit of asking because it didn't make a difference. Probably a question the parents may not know the answer to, kind of thing that getting the answer could create tension. So maybe for the residents, you continue to give the trustee complete discretion as to how to allocate it among the siblings, unless the family just has an answer for you. Another insight into our brave new world. So for estate tax purposes, as I've said, parents used to use cuperts, in which they would continue to reside in the homes, but then they commit to a future gift of the home in the future, some decades later maybe, at which point they'd commence to pay rent to their children. When cuperts came into existence in 1990, we already had the parent-child exclusion, 4 years earlier, meaning in California, we've never tried cuperts without a parent-child exclusion. Someone has said to me that Prop 19 will probably bring an end to the use of cuperts in California because nobody's going to want to have that reassessment. Likely, they're going to anticipate likely during their lifetimes. Well, by definition, yes, during their lifetimes. In conclusion, how would I evaluate Prop 19? In my opinion, it is a reasonable way to increase tax revenues without scrapping Prop 13 entirely. And I'd say it deserves to have more support than it's getting. One thing I'm feeling very strongly about in these COVID times, so just for the last year, is that governments are going to have a lot more work to do, Our old hostility to tax increases, may be outdated. If a tax is executed in an even-handed way, someone needs to come out and acknowledge it and say, hey, at least they did that. And let's look at this tax. I mean, it's progressive. The $1 million phases out as homes get more and more expensive. It reduces lock-in in surrounding the property tax, which discourages market transactions. I've heard some people characterize this proposition as a boon to real estate brokers, and that it reflects their lobbying in favor of the bill. I have 2 points to that. First, let's not try to characterize laws by the people who support them. I mean, that's why you have lawyers, and that's why economists are out there. We'll tell you what a law does. You don't have to, play the ad hominem game. And second of all, I have a hard time being bothered by a law which takes 2 transactions which were taxed differently, parent to child versus parent to stranger, and then brings them onto a level playing field. I mean, isn't that what we tend to prefer, is level playing fields? Yeah, it does put children in a rough position of having to sell inherited property if they can't afford the tax bill, but they acquired it with a stepped up basis. So they're not going to have to pay income tax on that sale, and they got the free income tax. And if they're not going to live there, I mean, nostalgia is often one aspect of it, but I suspect that the reason for the way Prop 19 was designed was to accommodate the nostalgia and the human aspect that you're going to live in your parents' home. That's one thing. But if you're not, and you're turning it into a rental property, the emotional ties that you have are going to be different. I don't want to be callous in that regard, but I mean, it's a fair point. Okay, so that's the end of the presentation. All this commentary I just made about my summation and the tax consequences, just keep in mind I have to give a conflict of interest speech, of course. One, I make more money when people make more taxes. And 2, I rent, I don't own my residence. So I have no idea what pain you people are going through. Thank you, and have a great new year.